11. Obstacles when creating and implementing your family business legacy plan. The greater the obstacle, the more glory in overcoming it. Molière. In this chapter, we will talk about the obstacles that business owners face when creating and implementing a family business legacy plan. Often, a business owner will procrastinate and postpone creating a legacy plan without realizing what it will cost her and her family if she delays and does not create and implement a family business legacy plan. Creating and implementing a successful family business legacy plan is not easy. It is loaded with emotions. Therefore, it is highly recommended that the business owner takes time to work with her trusted advisors and family members to create and implement a successful family business legacy plan. About 40% of the business owners I interviewed for this book did not yet have a succession plan because they did not know where to start, and it is a time-consuming process. Also, some business owners felt it was too early to start a succession plan. It should be noted that it is never too early to plan for succession. Therefore, I highly recommend that you start the conversation, especially if you are concerned about paying too much money on taxes, which, if you properly plan, you can leave extra funds for your mission-based charities. You will also enjoy the comfort of knowing that your loved ones will be taken care of. Also, business succession requires the business owner to create a new vision for the company and a transfer plan that is fair and equitable to all parties involved, including outside talent and family members who are passionate about the business. Remember, more time equals more options, such as implementing tax strategies that may give you, your successor, and your business increased cash flow. Having more time also gives the business owner the opportunity to teach and train successors and to provide insightful information about the business. Business owners are often overwhelmed about succession planning, but you do not need to know all the answers. Hire qualified advisors to help you with the planning process. Some business owners are concerned that they cannot find adequate advice. They do not know where to start. You can start by determining the value of your business based on earnings, book value, multiples of revenue, earnings before interest and taxes, and many other factors. Often, valuation is based on three major methods: the income approach, the cost approach, and the market or comparable sales approach. My preferred method of determining value is based on earnings before interest, taxes, depreciation, and amortization, EBITDA. Business owners are often concerned about business succession planning because it is not just about naming your replacement. It involves comprehensive updates to every major facet of your operation, including your foundational legal, financial, tax, and insurance systems. In my experience as a family business advisor, the major obstacle for creating and implementing a family business legacy plan is that business owners believe that the process is too complex. With family businesses, succession planning is even more complicated because of the family members' relationships and high emotions involved, and because many people do not feel comfortable discussing topics such as aging, death, and financial affairs. If transferring the business, it is important to realize that management and ownership are not the same. Based on the skill set, knowledge, and maturity of your children, you may or may not decide to transfer management of your business to just one of your children, but transfer equal shares of ownership to all your children, whether they are actively involved in operating the business or not. However, it is critical to consult with your business advisors, including your accountant, tax advisor, attorney, and family members, to obtain advice about strategies to minimize taxes and create and implement a family business legacy plan that is fair and equitable to all stakeholders, including the International Revenue Service, IRS. Other business owners simply do not want to think about leaving the company yet. Some business owners believe that they are years away from stepping away from the business, and therefore they do not need to worry about succession now. Some executives have immortality syndrome. They do not want to deal with their mortality. Also, for some executives, it is simply a matter of avoidance. They are not ready to give up their position in the company and cannot contemplate being replaced. Some business owners do not want to think about retirement because they have conflicts with family members or employees. Of the business owners who expect to retire or semi-retire within 5 years, 45% have not chosen a successor. Older business owners who are closer to retirement are no better at planning. Of the business owners 61 or older who are expected to retire within 3 years, 50% have not yet chosen a successor, and those who do not often try to clone themselves. Choosing a successor is not about cloning yourself. It is about finding someone to build upon what you have accomplished and take your business to the next level. The most qualified successor may turn out to be someone whose leadership style, skills, and business strategies are quite different from yours. Provided the two of you share the same fundamental values and vision for the company, you must not let the fact they approach things in a different way than you cloud your judgment. One of the major obstacles to create and implement a family business legacy plan is the lack of knowledge of estate taxes. Estate tax is a tax levied on the net value of the estate of a deceased person before distribution to their heirs. It consists of an accounting of everything you own or have certain interests in on the date of your death. The fair market value of these items is used, not what you paid for them. The includable property may consist of cash and securities, real estate, insurance, trusts, annuities, business interests, and other assets. Often high net worth individuals and business owners are concerned about the cost of estate taxes. According to the current Internal Revenue Service guidelines, estates of descendant residents, citizens of the United States, the simple estates including cash, publicly traded securities, small amounts of other easily valued assets, and no special deductions or elections or jointly held property do not require the filing of an estate tax return. At the time of this writing, a filing is required for estates with combined gross assets and prior taxable gifts exceeding $11,580,000 in 2020 and $11,700,000 in 2021. For estates of non-citizens of the United States, the estate tax is a tax on the transfer of U.S. situated property, which may include both tangible and intangible assets owned at the descendant's date of death. The computation of the tax requires that you state the total value of assets situated in the United States, and generally requires a separate statement of the total value of assets situated outside the United States. The two totals are the gross estate in the United States and the gross estate outside the United States. Property includable in these two totals may consist of cash and securities, real estate, insurance, trusts, annuities, business interests, and other assets. To value the assets held at the date of death, the fair market value is used, not necessarily what was paid for them or what their values were when they were acquired. If you do not file your taxes on a timely basis, and/or you have a past due tax return, you will have to pay to the Internal Revenue Service, IRS, interest charges and late payment penalties. Also, the IRS can impose a federal tax lien, which is the government's legal claim against your property when you neglect or fail to pay a tax debt. The lien protects the government's interests in your property, including real estate, personal property, and financial assets. The IRS may also file a public document, the Notice of Federal Tax Lien, to alert creditors that the government has legal right to your property. The cost of not creating a well-established and codified formal plan for succession may produce disastrous consequences for a family business. As we can see, postponing the creation and implementation of a tax-effective family business legacy plan can be an expensive and annoying experience. Therefore, I encourage you to stop procrastinating and start the conversation today with your trusted advisors to provide guidance and clarity to enable you to create a family business legacy plan that works for your personal, business, and family needs.